Hi folks, welcome to RJ Impact. Sam Bankman Fried, under house arrest in Palo Alto, California, has continued to publicly defend himself against fraud charges in the wake of the bankruptcy of his crypto exchange FTX. This week he launched a new Substack and posted a first article in order to make his case. I'm going to give him fair comment and drop his post here together with my summary. When I've finished, I'll show you what he either misses, hides, or deliberately avoids. As we go through it, see if you can see the same really obvious and really damning omission from the article before we get there. So in his very first post, he commented, "I didn't steal funds and I certainly didn't stash billions away, and no funds were stolen." He provides the story of how FTX failed, quite rambling in some ways. I'll scroll through it so you can read it if you want, but I'll highlight a couple of points he makes before we get to what's missing. His synopsis of FTX's failure. He talked about how FTX had loaned billions to Alameda, who then lost around 80% of its assets value in the crypto crashes in 2022. Alameda in turn had failed to hedge its own exposure to the crypto price falls of this extreme level. He points to CZ, the CEO of Binance, as the trigger for the insolvency of Alameda. This was in relation to a tweet that CZ put out saying it would sell its whole ownership of FTT, which is FTX's proprietary crypto token Alameda was using as security for its loans. SBF calls it CZ's fateful tweet. There was essentially then a run on the bank at FTX, with investors withdrawing their funds, and as Alameda couldn't pay its loans back to FTX, insolvency followed. So that's the background story. Very early yet, but any thoughts on what he's missing? Let's continue with what he does say. By the numbers. He presents a lot of numbers to highlight just a couple that show his analysis of the impact of the market's crashes. In late 2021, the balance sheet of Alameda shows that it had net assets of $99 billion. Net assets are all its assets like securities, cash, investments, etc., less all its liabilities, loans, etc. But by October 2022, its net asset position had deteriorated, but was still $10 billion. But by November 2022, just as it went insolvent, its net assets became zero. Okay, I don't know about you, but to me that's an incredible state of affairs. He's pointing to the fact that Alameda lost around $100 billion in a year. I have to point out here that I have no way of verifying those numbers, and he himself points out that they are just estimates. I think that there is one thing really clear: a lot of that value is going to be in the price attributed to things like the FTT token. I've questioned the approach to its valuation in previous videos, so the validity of the 100 billion should be taken with somewhat a pinch of salt, but nonetheless, it's still a huge number. CZ. SBF says insolvency was caused by an extreme quick targeted crash caused by CZ. Now, SBF and CZ had a feud running publicly via social media feeds. Essentially, they fell out as SBF accused CZ of hampering its ability to expand into new markets, and I won't go into that now. Customer funds. FTX US customers should get their funds back as it was fully solvent even at the time of liquidation. SBF himself says, "I still think that if FTX International were to reboot today, there would be a real possibility of making customers substantially whole. And even without that, there are significant assets available for customers. It's ridiculous that US customers have not had access to their funds." Okay, so that's a bit more of the picture painted, and notice anything missing yet? We'll get to it soon, I promise. Let's continue. Lawyers. There's a conflict of interest going on. This is because one of FTX's primary law firms, Sullivan & Cromwell, S&C, strong-armed and threatened SBF into appointing the chosen CEO. This CEO then took the companies into bankruptcy, and who did he appoint as counsel in the insolvency? Yes, S&C. Spending. Consumption, donations, investment all came from earnings, and sponsorships, by the way, were far less than revenue. Their branding and market spend is less in proportion to other cryptocurrencies, and the luxury Bahamian property that FTX purchased was required to attract the right workforce from the Bay Area and New York. His final sentence says, "I have a lot more to say about why Alameda failed to hedge, what happened with FTX US, what led to the Chapter 11 process, S&C, and more. but at least this is a start. Right, so that's my summary of the article. Did you get what he's meant to comment on? Maybe you thought about it, in which case well done. Or maybe you didn't, that's okay too. But there isn't one, but two elephants in the room. Let me reveal. Firstly, the special relationship between Alameda Research and FTX. Alameda in one sense is just another customer of FTX, but in reality it is a related party. SBF is a primary owner of both. Now, FTX had a so-called liquidation engine. This meant that any customer with a trading position that might go underwater would automatically have its position closed, and this would avoid FTX having to pick up their losses. We designed a system that we think will withstand huge market moves and huge volume, was how FTX publicly touted it as a benefit for the company. Except that FTX didn't require Alameda Research to undergo the auto-liquidation regime. The SEC in their indictment says that Bankman Fried ordered that Alameda be exempted from the auto-liquidation of FTX. So FTX then was on the hook for Alameda's losses, and so ultimately were FTX's customers. SBF has said to investors that Alameda was just another platform customer with no special privileges. So was he responsible for exempting Alameda? Now, as this had the knock-on effect of exposing FTX to Alameda's losses, and this in turn led to the saga of the implosion SBF is describing here, this is a really big omission from his narrative. And the second elephant in the room, customer funds. Customer deposits / funds were supposed, as documented in the legal contract between FTX and customers, to be segregated by FTX so that they would be protected for the customer. According to Caroline Ellison, the CEO of Alameda, customer funds of FTX were being used to cover Alameda's losses. In fact, customer funds were actually diverted from FTX directly to Alameda, who used them also to cover its own losses. It seems to me that all observers of this case, including yours truly, believes this to be true. I've actually listened to SBF being asked that direct question in interviews. His answer very clearly avoids the point and rambles in a different direction. Mishandling of client accounts is fraud, and SBF doesn't address it anywhere. Well, that's got you up to date with his first blog / article, and hopefully that's been informative. And if you've liked this content, then please hit that subscribe button to avoid missing out. I'll whistle a tune if you do. By the way, I couldn't see any comments on the Substack post that SBF made, so I'm not able to gauge any general consensus on any of it yet. If you have thoughts, then please let me know. I would appreciate that. Bye for now.